Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be taking a look at Dominion Energy stock, ticker symbol D. This one came in by request down in the comment section of one of my other videos. If you have a stock you would like me to analyze on the channel, just drop it down in the comments. I'll put it on the whiteboard behind me and eventually I'll make a video. If it's a ticker that's in the S&P 500, I post those on YouTube for free. Occasionally I'll post an extra one on YouTube for free, but most of the time, if it's a stock that's not in the S&P 500, I post those on Patreon, which is $5 a month, and also in the Cyclical Investors Club service, my full investing service over on Seeking Alpha. If you join Patreon, you can get a big discount to the full Cyclical Investors Club service. As always, this isn't individual investing advice. This is just how I analyze stocks, and those links will be down in the description as well. I'm going to be using Fast Graphs, which is the graphing service here, to take a look at Dominion for most of the calculations. I have a 25% off affiliate link down in the description for Fast Graphs as well, if you think it's useful. I do, especially for sifting through stocks like we're kind of doing now. And for earnings-based analysis. So, Dominion, okay, man, this one's a pretty easy one. If you look at the dark green shaded area here, over the past 20 years, that's earnings per share. This little white line is the dividend. And let's see right now. So it's yielding 5%, even though they cut it here because the stock price has fallen so much. Now, I think the fast graph is pretty useful in a situation like this because you can see that other than after when interest rates went to zero, we saw a kind of a steady build into dividend-paying stocks like utilities. There was one brief sell-off here. I actually did buy a utility ETF for defensive purposes during this little stretch from here to about here, and it worked out really well for that very brief period. But once that initial kind of wave of yield-seeking investors bought utility stocks like this one, because bond rates were low to zero, I mean short-term was basically zero, then it kind of they stayed at the valuation they were at basically. So if you go back to like a normal time, I mean I'm not sure what we could do. Let's call it like a 15 here. For a utility, you know, down to 13, right? 13 to 15 to 16 right in there. We'll say 15, which is where this orange line is, would be kind of like normal. Actually, for these guys, it might be 12. Yeah, 12 to 13. And then we got into this unusual era where dividends were growing for a utility. Even though they were growing faster than earnings, so people were attracted to the dividend growth and the dividend yield. But eventually, dividends can only rise as much as earnings do because the dividends come from the earnings. They aren't in addition to the earnings. I often run into people who think that the dividends are in addition to the earnings, but they actually come out of them. So you really see that lesson here with Dominion. So you can go back to, I don't know if they show the payout ratio here. Oh, they do. Okay, 50%. So back in the Great Recession, the dividend payout ratio, which is the difference between the earnings and the dividend payout, right? So if they earned $3, then the dividend, would have been, that was almost exactly what happened. So the dividend was $1.58. That means they probably earned a little over $3.16 a share. So half those earnings were paid out in dividends for that year. So that's, there's a big space between 50% and say like 90%, which would maybe be close to the most that they could pay out without borrowing money or something like that. So as we trace this throughout time, we're at 50, 53, 54, 64, 69, 70, 75, 73, 84, 82, 87 almost, right? We get almost up to that 90 that I didn't look at this beforehand. I just noticed the pattern in the chart. So when the distance between these two closes, that means there's really no more room left for dividend growth. So when I do a dividend stock analysis, which I'm not going to do on this one, that's why you have to look at earnings too if you're going to project forward how fast they might be able to grow earnings, right? Let's actually just go into performance here, and let's look at the dividend growth rate just to give you an idea what I'm talking about for dividend investors. So the dividend growth, let's go right to when it started rising, which was around here. So the dividend was growing 11% here, and then it's probably averaging 6%, I would say, through here. I can adjust, actually. Let me adjust this so we can find out. You can adjust the time frame, and let's go up to 2019. And then go down, and then it will calculate what the average dividend growth was during this time period. So it looks like 7 just glancing at it. Scroll down a little. Oh, it's up above. They changed the order of this. This used to be below the thing. So yeah, so 7.79% from 2008 to 2019. That was the average, right? Or 7.7 if you use it compounding. So that's how fast, and that, if you bought in 2008, that was a big dividend yield. So let's look at that real quick. So if you bought down here, that was a 4% yield, 4.5% yield. So it started at a 4.5% yield, and then it grew at almost 8% over time. Now, the problem happens when earnings don't grow as fast as the dividend. So if we just use the fast graphs, which if I did this, I would take into account these downturns here, but just slight declines. But you can see earnings only grew at 2.71% over this time period. So the dividends are growing, about 3 times faster than the earnings. And you can only do that for so long until the dividend payout catches up with the earnings and the dividend can no longer grow. And if the earnings fall, then guess what? There's no cushion, there's no margin for error there, and then the dividend has to also be cut. And so that's what happened in 2020, and again in 2021, when earnings fell and they could probably see that the future wasn't boding well. They probably needed some cash flow, and so the dividend got cut, right? So while there wasn't any, you probably couldn't have known for sure on the surface looking at a chart whether that the timing of when that dividend cut would come. You could look at it and tell that, look, they're paying all their earnings out in dividends, so there's no margin for safety here, basically, because they have debt, so that means they have interest they have to pay on the debt that has to come out of earnings as well. There's other things that they have to pay besides the dividend, right? So yeah, this is why looking at a dividend, if you are going to, you need to be careful of this difference in growth rate. But the other important thing is the dividend should really be the last thing that an investor looks at. I preach a lot against not having dividends be like the primary thing, but there's so many people that are doing it that I'm not going to tell people that they can't invest how they want to. But the danger is you see what happens here. Actually, this is just a perfect. So we get to 2020, okay? The dividend gets cut. Well, if you wait until the dividend gets cut before you sell, you're going to lose a lot more money, right? I mean, and then often, more people will get attracted. The dividend yield is actually higher right now at 5% than it was back in 2008 when it was 4.5%, but the fundamentals are much weaker. So the dividend is the trailing result, not the leading indicator. So you're much more likely to get caught in these declines if you're watching the dividend in how it grows or shrinks than if you're watching earnings and how they are growing and shrinking. So I'm doing a lot more extra commentary on this because the analysis is very quick. So if you just shrink this down to like more recently, I don't really buy turnaround stocks. Now, if this was thought to be like a one-time issue that was going to bounce back quickly, usually analysts will have that correct, and they do have some bounce back here. But this is a steady weakness, and the weakness was there before. We already showed you that from 2008 to 2019, they only grew earnings 2.7% per share over that time period per year. Well, inflation was like probably 1.7, 1.8. So 1% is all they grew earnings per year. So there's just no earnings growth. And when there's no earnings growth and people are paying nearly $20 a share, see, I look at this and that's just insanity to me. So it's really just, I'm like, why would anybody pay 20 PE for 3% earnings growth at best, right? A lot of other utilities have been able to grow earnings about 6%, so they've been able to do better. So you could look at some of those, and maybe if they were trading at 10, 12, maybe they're okay, right? If that's the type of thing that helps you sleep better at night. But you really got none of that with Dominion ever. There was never any reason to own the stock when it's 20. All this time it traded at 20 PE. And a lot of times people will say, well, utilities need to be treated differently and they're safe, and they're not. And if anybody read Berkshire's or Warren Buffett's annual letter this year, they own utilities, they should be really, really scared, because Berkshire has the best utility in the country in Berkshire Hathaway Energy, which has grown 9% a year. And Buffett was like, basically, he can't predict what the risks are for their business with wildfires and lawsuits and things like that. And the type of, capital that you have to put up over the long term, things need to be more predictable, and they're really getting less predictable. So if that danger is there for Berkshire, and we've seen it happen. We've seen it happen to, was it P&G in California? I might have the name wrong, and then Hawaiian Electric in Hawaii. I don't follow these super closely, but whenever anything happens, they're just going to go try to extract as much money as they can from the utility, or blame the utility over something that just happens as a normal course of doing business. And that's the environment that we are in right now. And so all these utilities pretty much have this risk baked in, and then they have no growth to offset it. So people think utilities are safe, and it might be the riskiest like sector in the, maybe REITs might be worse or riskier in terms of risk to reward, because the reward is quite low and the risk is quite high. So there might be other places where the risk is high, but the reward is at least high. There's a chance you can get earnings growth, out of some of these other companies. But utilities are pretty much in a void. So if you look at the actual numbers here, earnings growth, negative. If you run a 10-year CAGR analysis, it's like 2% under inflation. So now, of course, we've had this decline. So if you reset everything from here and earnings come back like they're expected to, then, they're expecting earnings to grow, what is this, 60, 70% over 30 years, so 30% or something a year. Maybe the stock price could rise 50%. To me, I can't predict that, though. Like, I don't have confidence to put my money in there, even though it's certainly possible. That's just not the level of risk that I want to take when I'm investing in stocks. So if this is like a one-time blip and everything goes back to normal, it could go up 50% in 3 years. It definitely could. It's fallen. This is what a lot of people don't really get. So it's fallen at least 50%, which means it could go up 100% if it gets back up to $90 a share again. So, but is that predictable? I don't think so. I don't think a person can really have a high confidence that that would happen. And even if the downside at some point is limited, which it not necessarily is, but let's say that it is, it could stay down at these levels for quite a long time. and just kind of wallow around there. Another dividend cut is definitely possible here too. And if that happens, the stock will fall even lower. So I would say if anybody is out there, I sometimes get a sense of like what people, I don't watch very many other YouTuber videos, mostly because I just can't. I would have to like respond. I feel like I had a responsibility to respond. So in some ways, when I get these requests, if I see a certain pattern coming in, haven't necessarily seen this with utilities, but I do see it sometimes on other platforms. If an analyst or a video YouTuber or a stock writer is out there recommending utilities, I would say they're always going to start their thesis with the dividend. And if they do that, then I would ignore them, because the dividend in these type of situations can really get you hurt. As investors have seen, if you bought the stock back, I'm just picking a random spot back here. How many years ago was that? 10 years ago. If you bought the stock 10 years ago, you got less than 1% a year now for buying and holding. That includes the dividend. So inflation's probably been 30% over that time. So you lost 30% of your purchasing power. And there have been a lot of people that have bought and hold this stock during that time that have found that out. But this can happen to almost any of the other utilities too. So, all right, hopefully you found this useful. If you did, hit the subscribe button. If you have a request, put it in the comments. I'll tell you guys exactly what I think. Sometimes more expansive, like in this video, because there isn't really too much to analyze in terms of an predictable earnings pattern. And if you like the video, hit the like, and I'll see everybody later. Bye.